The Dow and the Nasdaq nearing yet more milestones. The Nasdaq is creeping up towards 10,000, while the Dow is nearing 30,000. And some are seeing some echoes of similar psychological milestones in 1999. Joining us now, Paul Hickey, co-founder of Bespoke Investment Management. When we talked to, I think it was Tepper who said it, or maybe it was someone else that said it, or was it Dahlia? Someone said that we were close. It seemed like 1999. People said, wow, should we run for the fences? And they said, no.
It was Dahlia.
Maybe it was Dahlia. Because there was another year and another 30% before
bottom dropped out.
Before the bottom dropped out. Where do you see similarities to 1999? You were a glimmer in your mother's eye.
Maybe it was John.
Huh? I can't remember. It was somebody.
It was John. I'll think.
Well, so I mean, what's interesting is we're looking at Dow 30,000 now, Nasdaq 10,000, right?
Yeah.
We were looking at Dow 10,000, Nasdaq 5,000. So the Dow has tripled.
Yep.
And the Nasdaq's doubled. So for all the talk about how tech is out of control, that just goes to show you a little bit of a difference. Granted, the Nasdaq had run up so much, but so while there's similarities, like I mean, if you look at it, there's some of the biggest arguments that say we're similar to 1999, 2000 are you have tech dominating. You have a high concentration of market cap in the largest stocks in the S&P 500, and you have growth outperforming value. But those are the similarities. There's major differences in that respect, though. So in looking at tech dominating, we have tech accounts for about 30% of the S&P 500 right now, if you include Facebook and Google. And back in 2000, it accounted for 30%. The difference, though, is the valuations. The tech sector was trading for 2.5 times the multiple of the S&P 500 in 2000. It's trading for about a 28% premium over the S&P 500 now. So we're, valuations, it's rich, but the tech sector's valuation is the highest in 10 years. But from 1995 to 2008, the premium was much higher than it is now.
It's because a lot of the dot-com stocks had zero on the P to E. On the E part, they had zero.
So, right. So, take the concentration angle.
Paul Tudor Jones.
So in 2000, we had Microsoft, Intel, Cisco, Walmart, and GE accounting for the 5 largest stocks in the S&P. Their valuation then, they were trading at an average of 56 times earnings.
Yeah.
The 5 largest stocks in the S&P 500 today could double, and they would be still trading at a slightly cheaper valuation than those 5 largest stocks were then. So
you're not concerned that these top 5 stocks are trading at 47 times earnings? That's not a concern for you?
Well, so they're not trading at 47 times earnings now. They're trading at about 28 times earnings on average. So they're the valuation's much more in line with the S&P 500. They're still more expensive, but they're not nearly as expensive as they were. And you can make arguments saying that they're, that they deserve the higher multiples. But, I mean, Facebook is trading for just a little over 20 times earnings. It's got a market multiple. So, I mean, we don't have nearly Intel was of the 5 largest stocks at the most reasonable valuation in 2000, traded for over 30 times earnings. Microsoft, I think, was close to, 80 times earnings. So it's a much larger difference. And then the growth versus value trade. Growth is outperforming value by it's even more than we saw in 1999, 2000. But again, you have growth was trading for 56 times earnings in 2000 versus 18 times earnings for value. Today, value's at the same multiple, growth's trading at 28 times earnings. So again, it's expensive, but it's nothing similar to what we saw in 99, 2000.
Andrew, as I think about my neighborhoods, my clients, they'd be asking, how do I make more money? He's thinking about how to build wealth. It's completely 2 different conversations between Main Street and Wall Street. You almost need a class of how to read the Wall Street Journal in school, along with a home economics class, so everybody can come up and participate.
I think any high schooler should be reading the Wall Street Journal. When I was in high school, we had to read the editorial section of the Journal and the New York Times, and just reading a business section, not even the editorial, the business section, just for people should learn personal finance and just how the markets are generally working overall.
These psychological milestones, I mean, we happen to base all of our numbers on base 10. I mean, they're meaningless, but they are psychological. And 30,000, you can get there, and it can actually be self-fulfilling that it affects sentiment at those levels getting through, but it really shouldn't make any difference.
1,000 points on the Dow is 3%.
That makes no sense. Anyway, thank you. But we're going to watch it anyway. We're going to have some hats printed up that say
and Nasdaq hats, so hopefully
Nasdaq 10,000. We'll get both.